the FT headquarters. Today we'll talk about ETFs, the use of ETFs in private client portfolios and the way their phenomenal growth is shaping the wealth management landscape. We'll also talk about the types of investments that are most in demand in the current market environment, the areas of innovation, and the key criteria for product selection. To discuss these topics, I have with me several leading private bankers and wealth managers. Thank you all for joining us. David, investors' increased cost awareness and desire for transparency combined with the proof of performance of active managers over the past few years. How important have they been in terms of growth drivers of ETFs?
Well, I think it's extremely important, especially on the cost side. I think there has been what we regard as a very healthy additional focus on whether active management actually is worth the money. Although there is an element of cyclicality here with the conditions in the last few years making it probably more difficult than ever to outperform, especially in certain very liquid asset classes. I think that the overall pressure on active managers to display performance, to be very clear about how they intend to generate alpha going forward. Is it just going to be alpha by epiphany, or is it alpha by process? Right? We prefer alpha by process because you can replicate it, and so you can maintain it. It's very difficult to replicate elsewhere. It's something that you can really build on and explain, and not be reliant on the great next thought from one individual. Where we are now is I think is a fascinating place where we as a private bank are taking in-house a lot more of the active decisions that we used to let active managers make. That's like the 3 S's: sector, style and size, right? But often we are making those decisions in-house and then using ETFs as implementation. And I think where things are particularly exciting for us right now is because of our scale, we can actually go to key ETF partners and identify gaps in their range, which are usually very niche things, like taking a slice, like an industry level in a smaller developed market, where usually they wouldn't release an ETF on its own because they fear it won't gather enough assets, and say, well, we are going to put X billion in it if you make it for us. So they're now making ETFs for us at exceptionally low cost, because we are basically the anchor investor into a whole new breed of very granular ETFs. I think that is really taking us to a next level in terms of our ability to target certain exposures in the passive product area.
Do you see that these low-cost, liquid and transparent vehicles are no longer used just for tactical calls, but also perhaps to play a more strategic role in client portfolios?
Yes, definitely. I think we're very conscious of keeping clients within their risk categories, and ETFs, passive vehicles, are going to be very efficient in delivering and helping achieve that goal. Obviously, active management adds some risk around keeping clients in those parameters. So we're less actually focused on short-term macro trades, more longer-term efficiency delivery of meeting client objectives. But an approximation, sort of about 20 to 25% of our portfolios is going to be passively delivered through passive vehicles. We're not moving into perhaps quite as exotic areas as David was suggesting. We're still using it in the core space. The problem is that you do get some ETF launches in some relatively esoteric areas, and those areas are hot for a while, and clients find themselves in them, and of course that area goes out of favour, and that ETF collapses into another ETF. The sort of proliferation of lots of ETFs isn't something that necessarily makes us enthusiastic about these vehicles.
We like to take a blended approach, so identifying active managers and perhaps blending them, taking a broad approach to ETFs. So we could use an ETF, for example, in those markets that are liquid, that are more efficient, where it is more difficult to find alpha, and blend that perhaps with a high conviction manager. If a client definitely wants 100% passive portfolio, we work very closely with our investment management research team. We can build that, we can select the best ETFs, but really it's a combination of both, and I think the clients like that flexibility. And also a lot of clients, I think it's been in the media a lot, the growth of ETFs, the underperformance of active managers, and clients have come to us, and it's really an education. ETFs do have a tracking error. You have to understand the constituents, underlying constituents. You have to understand the market and the structure behind it. And sometimes, especially with the new ETFs that are coming out, the smart beta ones, they're not that cheap. And so active managers are more comparable.
The ETFs have changed the way all we invest. I mean, in the past, only pension funds used ETFs and managed accounts. Then banks, we started to use ETFs, maybe more for tactical shifts. Then we started to integrate ETFs into our core holdings. And nowadays, with the evolvement into smart beta, into factor investing, you basically can slice and dice almost every segment. So in the end, I mean, we have passive portfolios. There the choice is clear. We use only ETFs and index funds. But in the so-called blend mandate, it's sometimes quite hard because you tend to have for almost every market and every time period like a very good active fund. And then it's really tough to make a call. If you think it's more like a tactical move, then I think it's fair to say that you even more tend to take an ETF because you cannot enter and exit quickly with an active fund.
The advantage of ETF is the extreme transparency. There is no other real fund that you can go on a website, on a platform and say, okay, well, what is your holding today? Well, ETFs, well, it's not real time, it's yesterday's data, but it's really very convenient to model and to integrate into risk systems.